I am D.S. Hadkar, Assistant Professor, Government Postgraduate Women's College, Bailhungal. In this video, we will discuss about corporate accounting, third semester BBA, affiliated to Karnataka State Akka Mahadevi Women's University, Vijayapur. In this video, we will discuss about the introduction to corporate accounting, company, characteristics of company, share capital and types of shares. These are the objectives of this session and outcomes of this session. The students will be able to learn about corporate accounting concept, company, kinds of company, share capital, types of shares, difference between shares and stocks. So here we'll see what is corporate accounting. In the previous semester, you may have learned financial accounting. So like that, in this semester, you will be studying about corporate accounting. So it is a branch of accounting. Here it deals with accounting for companies. Corporate accounting, it deals with accounting for companies, preparation of their final accounts like P&L account, that is profit and loss account, balance sheet, and cash flow statement, analysis and interpretation of company's financial results, and accounting for specific events in case of companies like amalgamation, absorption, preparation of consolidated balance sheet. We call it as a corporate accounting. It is a branch of accounting which deals with a company. Then we'll see what are the difference between financial accounting and corporate accounting. Financial accounting deals with many transactions. Corporate accounting deals with a specific transactions relating to corporations. And second one is on the basis of efficiency. Financial accounting main purpose is to find out a profitability of the firm. In corporate accounting, here we'll be finding the cause and reason for that profitability with the help of corporate accounting. Then third point, on the basis of proven information, the information for financial accounting will be the transactions. Here in corporate accounting, we'll consider the estimates and facts. Then fourth point is reporting focus. Here financial accounting focuses on financial statements, but corporate accounting will be focuses on the operational reports. Then fifth one, standards. Financial accounting comply with various standards, whereas corporate accounting it does not comply with many accounting standards. Then sixth one is a system. Financial accounting does not pay attention on overall system of a company or outcome. This corporate accounting focuses on bottleneck operations which enhances profit. So these are the differences between financial accounting and corporate accounting. Then we'll see what is corporate or company. So as you know, there are many forms of business organizations. It may be a sole trading concern, Hindu undivided family, partnership firm. So these will be having a many limitations. Then the large establishments will be started with a joint stock company form of organization. So here in this we'll see what is company. Company is a voluntary and autonomous association of certain persons with capital divided into numerous transferable shares. Transferable shares, we call it as a company. Company is, it is an association of persons. The capital of the company is divided into different shares. That shares are freely transferable from one person to another person. Such association we call a company. Then we'll see a definition of a company. According to Companies Act 2003, Section 2, subsection 20 defines company as a company formed and registered under this act or an existing company. We call it as a company. Any establishment registered under a Companies Act, we call them as an company. Then existing company means a company formed and registered under any of the former Companies Acts. Former Companies Acts, now it is a 2013 Act. Before that, the 1956 Companies Act 1956 is a Farmer Companies Act. Any company registered under that also we call them as a company. Then we'll see what are the characteristics of a company. First one, it is a legal entity. Company has a distinct legal entity independent of its shareholders or members. There is no relation between the members and the company. Second one is limited liability. The liability of the members is limited to the extent of face value of the shares held by them. Fourth one, separation of ownership and management. Ownership of the company lies with shareholders, but it is managed by the board of directors of the company. So there is a divorce between ownership and management. Next one is capital contribution. The capital is contributed by the persons called shareholders under a Companies Act. Next one is distribution of profit. The profit earned by the company will be distributed among shareholders as a dividend. Next one is transferability of shares. Shares of the company are freely transferable except in case of private company. Common seal. So company is a artificial personality. So it has a distinct existence which will be evidenced by a common seal. These are the characteristics of a company. Next, we'll see what are the different kinds of company. Company will be categorized into different categories. First one on the basis of incorporation, then on the basis of liability, third is on the basis of investment. These are the three categories of the kinds of companies. So first one on the basis of incorporation. In that first one is chartered company. Company which is incorporated under a special charter by a royal charter with certain objectives, rights and duties. We call them as an chartered companies. For example, East India Company. Second one, statutory company. Company which are brought into existence and governed by special acts of legislature are known as statutory company. For example, RBI, Reserve Bank of India. It is established under RBI Act 1949. Third one, registered company. The company which is formed and registered under Companies Act 1956 or any other act, we call them as an any other previous any other Companies Act, we call it as an registered company. Then second category on the basis of liability. In that first one, limited liability company. Limited company. A limited company in which the liability of the member is limited to the extent of face value of the shares held by the member. We call them as a limited company. Second one, guarantee company. So guarantee company, in case of winding up of the company, means closing out of the company, if the memorandum mentions the liability of the member with certain fixed amount of guarantee, then we call it as a guarantee company. So guarantee company, in case of winding up, the members has to contribute a fixed amount. Third one, unlimited company. The liability of the members is unlimited in the event of winding up of the company. In the event of winding up of the company, the members are liable to the full extent of their fortunes to meet obligations of the company. We call them as an unlimited company. It means if The loss has to be borne by the members by their private properties. Third, on the basis of public investment, there are two categories. One is private company, second one is a public company. Private company is a company which by its articles restrict the transfer of its shares and the number of members limited to 200 and prohibits an invitation to the public for any shares and prohibits acceptance of deposits from the persons. We call it as an private company. Private company is a company which restrict first one transfer of its shares. The number of members is 200. Prohibits invitation to the public for any shares and prohibits acceptance of deposits from persons. Then the private company has to mention in its name private limited. Second one, public company. Company which are not private companies, we call them as an public company. Means there are no restrictions on transfer of shares, on number of members, on invitation to public for any shares and accepting the deposits from the public. We call them as an public company. Then we'll see the companies which are deemed to be public. A private company which we consider it as a public company under certain circumstances. First one, if 25% or more of its paid up capital is held by one or more bodies corporate. Second, if it holds 25% of paid up capital of a company. If its average annual turnover is not less than rupees 10 crore, subject to change in a ceiling. Fourth one, if it invites deposits from the public or renews deposits from the public other than its members, directors, or their relatives, then we treat it as a public company. Then we'll see a share capital of the company. Companies Act 1956 section 2 subsection 46 defines share a share in the share capital of the company and includes stock except where a distinction between stock and share is expressed or implied. So share capital of the company is divided into different units with definite value called shares. The total capital of the company is divided into different parts or units. Each unit is called as share. The share capital is the amount of capital raised or to be raised by a company by the issue of shares. By selling a shares, the total amount of capital which has raised by the company, we call it as a share capital. The share capital of the company will be shown in the balance sheet of the company. The share capital of the company is divided into different divisions. They are: first one, authorized capital, issued capital, subscribed capital, called up capital, paid up capital, and reserve capital. First one, authorized capital. The amount of capital with which the company intends to be registered is called nominal or registered or authorized capital. It is the maximum amount which the company is authorized to raise by way of public subscription. It is a maximum amount of share capital which is registered with registrar of company. Second one, issued capital. It is a part of authorized share capital which is offered for sale to the public is called issued capital. Say, for example, the company is registered with 5 lakh share capital. So 5 lakh is authorized capital. Out of 5 lakh, if the company wants to sell only 3 lakh capital, then it issues only 30,000 shares of rupees face value 10. So that 3 lakh we call it as an issued capital. Third one, subscribed capital. It is a part of issued share capital which is actually taken up by the public. It means when the company issues shares to the public purchases the shares of the company. The shares purchased by the company, we call it as a subscribed capital. If the issue is subscribed by the public, the entire issued capital will be the subscribed capital. Then next one, fourth one, called up capital. It is that portion of the subscribed capital which has been called up by the company. So again, it is a part of subscribed capital which is collected by the company. Then we call it as a called up capital. Then fifth one, paid up capital. The amount received against the calls made on these shares. We call it as a paid up capital. The actual amount of capital paid by the shareholders is a paid up capital. The unpaid balance of the called up capital is known as calls in arrears. The unpaid amount of called up capital is known as calls in arrears. Then sixth one is reserve capital. Reserve capital is the amount of uncalled capital which the company has by special resolution decided not to call up except in the winding up of the company. We call it as a reserve capital. Means company is reserved this capital till at the event of winding up of the company. But this reserve capital cannot be distributed as a dividend to shareholders. For example, a share premium, profit prior to incorporation, forfeited shares account. Then we'll see what are the different kinds of shares. There are two kinds of shares. One is preference shares, another one is equity shares or ordinary shares. Then first one, preference shares. The preference shares are those which have some preferential rights over the other types of shares. Then we call them as a preference shares. The share to be preference share, it needs to have two preferential rights. One is the dividend to be paid during the lifetime of the company. Another one, if the company goes into liquidation, they have a preferential right to return of capital. One is in case of dividend, another one in case of repayment of capital at the time of liquidation. And second category is equity shares. Equity shares are those shares which are not preference shares. They are also known as ordinary shares. They are not having any preferential rights. Types of preference shares. there will be a four kind of preference shares. One is cumulative and non-cumulative. Second one, convertible and non-convertible preference shares. Third one, participating and non-participating preference shares. And fourth, redeemable and irredeemable preference shares. First one, cumulative preference shares. Cumulative preference shares, the unpaid dividend of preference shareholders will be cumulated or forwarded to the next year. Then we call it as a cumulative preference shares. Then non-cumulative, the dividend cannot be carried forward to next year. Then we call it as a non-cumulative preference shares. For example, if the company is not earned profit in this year, then this year dividend, fixed rate of dividend, will be carried forward to the next year in case of cumulative preference shares. Non-cumulative preference shares, holders will get the dividend only when the company earns the profit. If the company does not earn the profit, the dividend will not be paid. Second one, convertible and non-convertible preference shares. The preference shares will be converted into equity shares after a certain period of time. We call them as an convertible preference shares. Non-convertible, the preference shares cannot be converted into equity shares. Then we call them as an non-convertible preference shares. Third one, participating and non-participating preference shares. Participating, in addition to fixed rate of dividend, if the company profit remains after meeting equity dividend, that will be shared by preference shareholders. Then we call them as a participating preference shares. Here in this, so they will get a fixed rate of dividend. Then when the company makes profit, again if the profit remains after paying equity dividend, in that profit also they will participate. Then such preference shares, we call them as a participating preference shareholders. Non-participating preference shareholders, the shareholders of preference shares are entitled to get only fixed dividend. They will not take part in the surplus profits of the company. And fourth one, redeemable and irredeemable preference shares. Redeemable, the preference shares will be repaid after certain period of time to the shareholders. We call them as an redeemable preference shares. Redeem means repay. Irredeemable, the preference shares are not redeemed until the company goes into liquidation, are known as irredeemable preference shares. Then sweat equity shares means the equity shares issued by a company at a discount or for consideration other than cash for providing know-how, making valuable rights in the nature of intellectual property rights. So any shares issued by company for certain services rendered by a certain people. For them, if the company has given shares at a discount or for any consideration, such shares we call them as an sweat equity shares. Then we'll see what is stock. Stock is a consolidation of fully paid shares, means consolidation aggregate. A set of shares together we call them as an stock. Also we call a bundle of shares as a stock. Stock does not have any definite value. For example, 10 rupee share is a 1 unit of share capital, face value of rupees 10. So 10 shares together, 100 rupee value, we call it as a stock. So 10 shares bundle, we call it as a stock. Each unit is a share, bundle of units is a stock. Then what are the difference between shares and stock? Shares may be fully or partly paid up. Stock, for the purpose of conversion into stock, shares must be fully paid up. Always stock will be having a fully paid up. Then shares originally issued by the company. Stock cannot be originally issued. It may be registered. Shares will be registered. The face value of the share is registered. The stock bundle is not registered. Shares are individual units of a capital of a company. Each unit. Stock, it is an aggregate unit. Share are distinctively numbered from serial number 1 to, but stocks does not have any such number. Then it is not possible to transfer fraction of share, means the fraction of share 10 rupee face value share we cannot divide. Stock, we can split the stock into different fractions, then we can transfer. For example, if you hold 100 shares, in that 100 shares 10 shares you can transfer. Thank you.